Hi, IBD. I'm Meredith Heyman. This is Industry Insights. Thanks so much for joining me. The 2026 stock market appears set for strength, following its third year in a row of double digit growth, bolstered by Fed rate cuts and continued AI investment. At the same time, tariffs are pressuring consumers, and it's a midterm election year. So, what's the best approach for having a winning investing strategy this year? Joining me to discuss the upcoming market trends and themes is IBD Deputy Markets Editor David Saito-Chung. Dave, thanks so much for joining me.
Hey, Meredith. Great to see you, and thanks for inviting me for today.
Absolutely. So, major themes from 2025 that we're going to see again in 2026. What can we all expect?
Well, at IBD, we really like to focus on earnings, what is the outlook for large cap companies, as well as what does the picture look like in terms of interest rates, very, very important factor for equity returns. We'll also talk a little bit about potential rotation in the leadership of the stock market and also maybe cover some points about wild cards that could affect the stock market, including policy moves by the federal government and overseas.
So, a lot to consider. So, more about the earnings outlook. How does that shape up for the S&P 500?
We really focus on what the research from FactSet does. And according to John Butters, he's a senior earnings analyst at FactSet, made some interesting points recently in a December 12th note. One, that in Q4 of this calendar year, S&P 500 earnings are expected to rise 8.1%. That's a healthy number, 8.1% growth year over year. It would also mark the 10th straight quarter of profit increases. So that's a tailwind for equities in 2026. Now, Butters also notes, Meredith, that the valuation of the US stock market is on the high side. If you look at the forward 12-month PE ratio, price versus earnings, it's currently around 22.5 times forward future earnings. That's above the 5-year average of 20 times earnings. It's also significantly above the 10-year average for forward PE of 18.7. So that is something that we should just keep in mind as we head into the new year. Also, another interesting point he made was that when you look at the estimates for what he calls bottoms up analysts predicting what the S&P 500 might do, over the next 12 months, they have an aggregate target for the S&P at 7,968. So right now, maybe it's a good time for me to share what the S&P 500 is doing. What do
Please.
you say? Okay.
Absolutely.
Yeah, so let me do that and go to the S&P 500 over on market search. This is a daily chart, and we can see that it's currently trading around 6,720. So once again, let me repeat that the aggregate price target currently is at 79.68, which would imply a healthy gain of more than 17% from here on. But keep in mind, according to Butters, that industry analysts have, quote, historically overestimated the closing price of the index at the start of the new year. And over the past 20 years, Meredith, they overshot the final price of that index by about 5.9 or 6%. So if we keep that overshooting in mind, maybe we could really realistically expect a gain of around 10% to 11% from here in the S&P 500 in late 2026. He also added that the information technology sector is also being seen as making the biggest gain and followed up by financials. Roughly 20% gain possibly for infotech and 8% for the financials. So in terms of earnings, this is overall a good looking outlook.
All right, let's move to the Fed. How will 2026 interest rate trends shape the investing environment?
Great question, Meredith. And I want to first look at the 10-year Treasury bond yield. This is based on SIBO data. And you see on this market surge chart, it says 41.51. You want to divide that number by 10 to get the actual yield you would get on investing in 10-year bonds. Right now, the Fed funds rate, which is a key interest rate for short-term lending, is at 3.5% to 3.75%. That's for very, very short-term loans. So it's a good thing, actually, that people who invest in bonds, treasury bonds, would be getting a higher rate of return, currently 4.15%, because of the risk of holding something that long. Now, we've had 2 years in a row in which monetary policy has eased. That's generally good for stocks. And right now, after we had a recent meeting with the Fed and Jerome Powell as the chair, the policy committee currently is expecting one rate cut for 2026. A lot of market observers believe there will be more, especially if there are more signs of economic slowness. So generally speaking, the lower cost of money, the better it is for equities. Why? Well, companies can invest more cheaply. They can borrow more to pay off debt. They also have more access to funding for stock buybacks and dividends. So those are all good factors for the stock market. And if we take a look at companies such as JP Morgan, JPM, has had a really good year so far. So has Goldman Sachs, major investment bank. You can see it recently hit 900. I want to focus also on Citigroup. This is a stock that recently broke out of a flat base, and I'm drawing the basic outline of a flat base here, where after you had a very nice move, the stock hasn't really given much uh, back, and we recently had a breakout last month. So financial stocks, to me, are also kind of affirming a positive outlook for the cost of money, the cost of lending, and that could feed well into the stock market.
Dave, let's move back to the market. Let's talk about leadership. How are we going to see that rotate within different sectors?
Yes, that's really important to understand what the market is actually doing, right? Because the S&P 500 and the Nasdaq only give you one view. If we look at a sector basis, for instance, take a look at gold. We can look at the Spider Gold shares, which is trading near multi-year, if not all-time highs. They've really done really well. And I think precious metals will be one area to watch closely as stock investors. And so will ETFs such as XME. This might include not just precious metals, but maybe industrial metal ores players. You can see that this ETF tracks the S&P Metals and Mining Select Industry Index, kind of like GLD. It's really had a phenomenal 7, 8 months. I'm also watching closely XRT. This is the Spider S&P Retail Index. As you can see that from the bottom of the very, very quick bear market we saw in the first 3 to 4 months of 2025, retail stocks have done pretty well. And let me go to a weekly chart here. You can see that it hasn't been a super uh, area for leadership. You can see on this weekly chart that this ETF, in fact, is still well below the 5-year peak. But this is an area that I think IBD is watching very closely as a place where there could be some future leadership. I also want to take a look at XBI. This is a leaderboard position, and you can see on a weekly chart here, this is tracking a range of biotech companies. What a really nice uptrend that we've seen. This accelerated to some degree. Still not at the all-time highs, as we can see here, but the trend is really good heading into 2026. Also, if I may, I'm going to take a look at some laggards. Here's XLE. You can see that we have a 32 relative strength rating for the Energy Select Spider ETF, which means that this ETF is outperforming only 32% or less than a third of the entire IBD database over the past 12 months. Let's also take a look at staples. Consumer staples as represented by XLP. This is below the 200-day moving average. We generally like to favor stocks and ETFs that are trading above key moving averages, such as the 200-day moving average. You can see that XLP has a 34 relative strength rating, not very good. So I think it'll be very interesting, Meredith, to see whether we have any reversal of fortunes among those areas that we just looked at. Let's also consider on Market Surge one of the strongest, if not the strongest, industry group right now, and that is for Market Surge users, we use G3552, the telecom fiber optics group. You can see that it's pulled back in recent days, but uh, it's had an enormous gain of more than 135%. G1040 is the gold and silver mining, also strong, up 122%. G3578 is the computer data storage area. This is up more than 90% at one point. And finally, let me introduce two more industry groups among the 197 that we have at IBD. Here is G1318. G1318 is energy alternative, including nuclear companies and not solar, but also such as geothermal and so forth. Let's also finally look at G4895. G4895 is telecom infrastructure, and these groups are up north of 70%. Plus, in 2025, we've seen 9 other additional industry groups up 50% or more. So what I'm looking for here is whether in 2026 we could see these groups digest those big gains or trade sideways for a while and possibly even build upon these amazing gains that they've had in 2025.
I mentioned the continued investment into AI earlier. How will that leadership evolve in 2026 in the market?
That's kind of like $1 million question that everyone wants to know. And the way we look at the market is that we try not to predict what could happen for the best chip, the best data center, the best software related names, the best companies that help these investors build the data centers going across the country. The best thing to do is to make a basket of these stocks and or ETFs and just observe them on a daily and weekly basis. And if you see unusual behavior to the downside or to the upside, then you got a good sense of where these stocks might be going.
You mentioned energy as one of the sectors to at least watch. Another sector, though, that has shown strength is healthcare. What can
hmm
we expect from that next year in the market?
Yeah, that's a great question. Right now, what we're seeing is there are pockets of strength within that vast part of the market. For instance, a couple hospital names have done really well. So have a number of biotechs. The GLP weight loss drug theme is still really, really strong. If we look at a company such as LLY, that's Eli Lilly. Let's take a look at the daily chart here. You can see that this mega cap recently broke out of a consolidation here and recently returned back above 1,000. Now, of course, they have a lot of different products, but I want to highlight the fact that earnings growth looks really strong. Their sales growth has been accelerating on a year-over-year basis. This will be a really good stock to keep on your watch list and see whether other medical stocks join Lilly as a potential new leader in 2026.
And Dave, moving on to how the government impacts the markets, we see evolving trade policies and tariff positions. This year is going to be midterm elections. How will that all affect the market?
Some big, big questions you're putting on my shoulders there, Meredith. And you know, clearly the market has been very sensitive to policies, starting with the tariffs that were announced in the Rose Garden at the White House in early April, and then the immediate about face in terms of whether those tariffs would be enforced. And it's amazing that the market has climbed amid this wall of worry, amid the fact that some tariffs have been in place and are filling the coffers of the treasury market. But clearly we're also seeing signs of inflation still a big concern to Wall Street, and also the slowing down of the jobs market. So it's going to be interesting to me in 2026 whether President Trump and his economic advisors, recognizing the concerns about the economy, might do any further shifts in their thinking. We also have the midterm elections, which can be a wild card for the stock market because, as we know, elections always breed uncertainty, and the market doesn't like uncertainty. So I'm looking to see whether we have more another couple bouts of volatility like we've had, for instance, in the summer of 2024 and the first 3 to 4 months of 2025. That's just part of the game with the stock market. But it's going to be interesting too whether at some point the market will tell us, okay, we're kind of now looking beyond those midterm elections. We'll get a better sense of what policy might be if there's a major change in Congress. And so best not to try to predict it. Just keep watching to see what the market really shows us, especially through the indexes and through the leading sectors.
Absolutely. And the IBD methodology we've talked about depends on a lot on what's new. So, to that, how's the IPO market looking for next year?
I'm so glad you asked that because there have been some really interesting names that I'm watching very closely. Would you like me to share a few tickers for our audience?
Please.
Okay, let's do it. So one of the most interesting ones right now is BLLN, and I hope you can see that daily chart where billion to one. What an interesting name for a medical research company. They're in a hot field, right? Genetic diagnostics. And according to Market Surge, they provide a special platform to look at disease and genetic mutations at a molecular level, which is sounds amazing, right? Well, stock is been choppy, as you can see, bouncing around within a pretty wide range, up as high as 138, down to 90. But it's traded well above that IPO price, as you can see here. I believe it says $60 a share, and then went public way above that price. So there might be the stock might need a lot of time to sort of hash out a proper trading range and maybe develop what IBD likes to look for, a bullish base in which to set up a possible breakout. But I like the fact that this company, Meredith, has some serious sales that are accelerating, big year-over-year growth, and also has become profitable. So BLLN is one to watch. Now, within the blockchain space, Figure Tech says they are the largest provider of home equity financing as a non-bank. Very interesting company. They specialize, as I said, in the blockchain, and they are a financial services company. Hence, they are in the specialty financial services group, which is now in the top third in terms of 6-month performance. This is a mid cap. You can see it has an $8 billion valuation. Funds own about 13% of the stock, and this stock is trading nicely above that $25 IPO. I'm going to introduce just two more real quick. This is JCap, which helps retrieve funds from delinquent accounts. You can see this stock has done well since its IPO at $15 a share. And then finally, I'm not sure if it shows up today. Yes, it does. In fact, Medline is a company that just went public. It's a major player in medical and surgical products supply. And this company has 43,000 employees globally, based in Northfield, Illinois, and is probably, because of this strong showing today after an IPO at around $29 a share, Meredith, I believe Medline, which is MDLN, just made a record in terms of capital raised in its IPO for the year. So there are some names here. The overarching point I want to make is that the more new companies that investors have to choose from, the better chance that a bull market can continue.
And to that, any wild cards to be looking out for in 2026?
Yes, I think the wild card would be the the chance that we could have a fourth year of strong gains. That's one positive wild card. Now,
I
you
should
know,
say
we've
so.
yeah, we've had good double-digit gains in 2025 for the S&P 500 and the Nasdaq. Let me just share that the 500 was up 24.2% excluding dividends in 23, up 23.3% in 2024. The Nasdaq Composite up 43.4% and 28.6% in 23-24. So on top of that, we have nice gains in 2025. Some people might doubt that we could have a fourth straight year of solid gains for our portfolios. Well, LP Research does a good job of looking at market history, and they highlighted that during the fourth year of bull markets, going back to 1950, the S&P 500 has actually averaged a 12.8% gain in that fourth year. That's a promising statistic. So that's a positive wild card. Also, LPL said that out of those out of the research going back to 1950, the fourth year was a positive year, 6 out of 7 instances. So we'll be watching that. Now, I would say another wild card would be obviously looking at crude oil. Crude oil has been really slumping. Just recently, crude oil futures hit a 5-year low. We've traded as low as $54.98. You could argue that crude oil is still in a bear market, and hence we haven't really seen much leadership in the traditional oil and gas area. If crude oil rockets, for instance, well, that puts pressure on inflation, and that could affect monetary policy and therefore people's views on how far equities can go in terms of permissible valuations. I see that as a key wild card to watch. And then finally, watching what other equity markets do. Ned Davis Research, they're a very strong equity research shop, and they also look at interest rates too. I'm going to quote from a recent report that they had, and they said that for now, this is Ned Davis Research. U.S., Eurozone, Japan, and India, quote, remain on a steady growth trajectory. NDR, Ned Davis, expects growth trends to, quote, ease modestly in the UK, China, and Brazil. So there's varying trends there, but according to Ned Davis, recession risk remains low across the board. So that's a good thing for equities, but keep in mind that predictions and forecasts can definitely change.
All right, Dave. Absolutely. We're going to just have to be watching. Thank you so much for joining me. I'm Meredith Heyman. Stay right here on IBD for more. We'll see you next time.